Hey, everybody, welcome back to the show. As you've probably no doubt realized in the first 5 seconds of the show, is that I'm not alone. I've got Big ERN, Karsten Jeske of Early Retirement Now. He's joining us today, and which is going to raise the IQ level, the average IQ level of the show significantly, I can assure you. If you can hear and see me and Karsten, give us a thumbs up, please. And while you're doing that, I'll sort of get things started and just ask Karsten, I don't know, say whatever you want to say to everybody. Give us a 60-second intro into who you are, what you're about.
So I'm originally from Germany. I came to the US in 1995, came here for grad school and stayed here ever since. And always in the back of my mind, I had the idea of early retirement. I think at some point I had this little bit of imposter syndrome, right? Where you think that you think you're very well educated, but then you're afraid that, well, everybody else around me is so smart. I mean, they're just going to find me out and I'm going to get canned at age 44 or something like that. So
Been there, done that.
So in the end, it turns out at age 44, so 7 years ago, I retired from my corporate job. So I used to work for many years, initially at the Federal Reserve. And then I worked in asset management at Bank of New York Mellon Asset Management. They have an office in San Francisco that was called at that time Mellon Capital Management. So it was part of Mellon Bank and then BNY Mellon. And it was one of their subsidiaries that was doing asset allocation research. And it's basically we were advising big institutional investors how to do tactical asset allocation over the major asset classes. So that was my shtick when I was in the corporate world. And so it turns out I did that for many years, over 10 years at BNY Mellon, and made enough money to realize that I was able to retire and never work again. So after that stint in San Francisco, my wife and my daughter and I moved to Washington State. So we liked it on the West Coast, and we're here now in Washington State and enjoying our early retirement. So we have a daughter in school, and so my job is now being dad, to going to the school bus, picking up my daughter from the school bus. I'm the math coach of my daughter's math team, so we have some statewide math competitions here. So I keep myself busy, obviously, with the blog, with some volunteering work, and so not writing as much as I used to, but so people still follow me and still enjoy having me on shows, just like you. So,
well, I thank you for taking time to spend an hour and a half with us. So for those listening, you can ask your questions in the chat. It's perfectly fine to direct one specifically at Big ERN. Can I call you that? I guess Karsten is more appropriate.
Karsten.
Karsten, you direct it specifically at him. If it's a more general question, he and I will likely just sort of discuss it, whatever. I thought I would kind of start off with a couple of questions for you. And the first one is, of course, your site is maybe the most well-known for the Safe Withdrawal Rate series that you've done, and it continues. I mean, you continue to add to it from time to time. And my question for you, you've probably researched this as much as anybody. Have you changed your mind about anything as it relates to safe withdrawal rates, I don't know, the last year or two or whatever?
Right. So I started writing about this in 2016, right? So it's actually long enough that obviously you evolve on certain issues, right? So one issue I've evolved on was in the beginning I was using this blog and my series as basically attacking the 4% rule because I thought it was too aggressive, and so I ran my own basically Bengen style or Trinity study style simulations, and then look at, well, if you do longer horizons, if you condition on expensive equity valuations at the time of retirement. So you basically wanted to take down your safe withdrawal rate a little bit below 4%, not drastically below 4%. So there was also some good news, right? So the good news was that you could do 60-year retirement even at the beginning of the Great Depression, and you would still survive with something like 3.25%. It's pretty amazing. So it surprised me. But then obviously over time, you do not just this academic exercise, you also look at some real world examples, right, of some real retirees, right? And the average retiree in the FIRE community is not some 28-year-old or 32-year-old with just very lean asset base and essentially no social security expectation. The average retiree in the FIRE community is somebody like me, right? I mean, you have a reasonably long work history. You say you retire in your mid-40s to mid-50s. You have some supplemental cash flows around the corner. You might also do something like a fat FIRE approach, right, where you have a little bit of a more generous retirement budget. So you're not as frugal as maybe the average retiree, which means that later in retirement, more likely than not, you're going to probably reduce your expenses, right? Because you probably, once you're 70, 75, 80 years old, you might travel less. And you might scale down your consumption. So if you take that all into account, you can very likely withdraw a lot more than 4%. So it's basically you should then also personalize your retirement analysis. And of course, you can't really write an academic style paper where you say, well, as a Bengen had to do something very bare bones, very generic. He couldn't do something like, well, this is a retirement exercise for my 67-year-old aunt, and she has this house and this car. And no academic journal would be interested in that. It has to be more general and generic. But once you look at actual retirees, you will find that they can factor in all sorts of little knobs where they can turn in the end, right? And where they could probably reduce their expenses. They can factor in that they get some cash flows later in retirement. And once that's all factored in, that even in the worst possible retirement scenario, if you retire right at the top of the bull market, right before
like now, by the way,
as we could be where we were right now, right? If you look at multiples, even then you probably withdraw more than 4%. So I mean, in that sense, I've changed. So personalize and personalize your withdrawal analysis, and you may find, you may be very positively surprised if you and maybe have some flexibility later of reducing your expenses. So that could make a huge difference in your initial rate.
Yeah, well, you know, as I'm sure you know, the research supports this idea. They call it the retirement spending smile, that we do spend less, even factoring in healthcare. Right. And of course, you know, each person has to sort of individualize it. It's not that everyone spends less, right? You might, but I can tell you from, you know, people that I know in their 80s and 90s, including my mom, my in-laws, and many others, I've yet to meet someone who spends more, even factoring in inflation and including healthcare, in their 80s and 90s than they did in their 60s and 70s. So yeah, that's and it's a bit of a tricky thing, because on the one hand, I think it's reasonable to assume that will happen, but there's part of me that's like, but I don't want to like go overboard with the idea, such that when I do hit my 80s and 90s, I'm scrimping too much. I almost feel like I've painted myself into a corner. But you do want to enjoy the money while you're able to. So second question, and then I'm going to turn it over to the viewers, and I've already got one lined up that someone asked. But before we get there, how do you think about asset allocation? And we can just do it for now at the stock bond level, or stock bond cash if you prefer. So in light of, you know, where you are and whatever approach you have to the safe withdrawal rate for your own family, to the extent you are open to sharing, what's your stock bond allocation and how do you think about that? Do you plan to change it either as you get older, or do you change it based on valuations, or maybe you don't change it at all?
Yeah, so right now I think we're at about 75% stocks, 25% fixed income. And so that's roughly in line with what I found is kind of the sweet spot in my safe withdrawal rate analysis. And so that's what we do personally. And so I do some other things too. We have a little bit of money in real estate funds. So it's a private equity real estate fund with the provider I still know from San Francisco. But it's not just in San Francisco. It's anywhere nationwide. So we do a little bit of that. And then on top of that, we own a house outright without a mortgage. So you can consider that something of an asset too. So that's not included in it. So in the financial asset world, I'm 75-25. So that roughly aligns with what I recommend for a static asset allocation. No, there is some research out there, right, that says that if you have a glide path, you could maybe trickle out just a little bit more in terms of safe withdrawal rates, because you hedge this really bad outcome. If you were to retire right at the top, it's better to have a little bit more bonds, and then you switch from bonds back into stocks, and then you basically you reshuffle and rebalance your portfolio through the trough, and then you kind of slingshot that portfolio out of the recession and into the recovery. It's not like you can take a 3% withdrawal rate or safe rate and make it 4%, but it's very small differences. So I've proposed that on my blog, and people have pointed that, oh well, you propose this, you're not even doing it yourself. And I said, well, you know what, I don't have to, and because I do some other stuff, I do some option trading, I have some income from my blog, so maybe it's not totally essential for me, but maybe some people who are worried about high valuations right now maybe start a little bit more on the bond side, 60-40, 50-50, 40-60 is probably as low as I would want to go. And because I remember just 10 days or 2 weeks ago, I think you discussed that in one of your 5 questions.
Vanguard issued a report.
Right. So so I wouldn't fault people for going a little bit less aggressive on the stock side, more aggressive on the bond side. Right. So stock valuations are very high. Bonds look pretty okay in terms of bond yields in the mid 4% for 10-year, even higher for the 30-year. So I wouldn't fault you. And then, I mean, the nice thing is, as I just said, with this glide path approach, if you think that this is too much bonds and not enough stocks for the very long term, right? So the way to solve this is, well, you don't have to be at 60-40 your entire life. Maybe switch it over time and transition into, say, 75-25 or even 80-20. So I would definitely endorse that.
Yeah. One idea I had, and this is unburdened by actually testing it with real live data. This was just a thought that crossed my mind. I probably bumped my head and this came into my mind, but was if someone was retiring and concerned about valuations, and here we're really talking about large US companies, because the valuations of international and small cap, even REITs, are not at the insane levels. So one way to deal with it is just to diversify across equities, but which is more or less what we do. But if you wanted 60-40, but you're nervous, so you start at 40-60, you could just, effectively start spending the bonds until your stock bond allocation got back to 60-40, and then level it off and rebalance. Or
exactly,
maybe your goal is 70-30. But it's a way to do it so that you don't really have to keep making decisions. Your only decision is, I'm going to go to this and I'm going to spend my bonds until I get back up to this.
Right.
Whether that's a good idea or not, and like you, that's not what I'm doing. I have the same allocation that you do, 75, roughly 75-25. But okay, good. Well, let's stick with asset allocation. So I don't know if, Karsten, if you'll able to see this on my screen, but I'll read it if you can't. This is from Kat. I listened to a podcast with Big ERN and Bill Bernstein, who's going to be on the show as a co-host later in the year. Anyway, debating small cap value. And I will say, Karsten, I don't know. I think I've read your view on this, but I don't remember what it is. So what's your view on tilting a portfolio towards small cap value? And I guess, have you changed your mind? I don't know when this debate was with Bill. But
so first of all, it was with Paul Merriman, not Bill.
Paul Merriman. Well, he's definitely a small cap.
And so he is a big proponent of small cap value. And I think Bill Bernstein is a little bit more balanced on that idea. So I already published one blog post in 2019 about why I didn't care too much about small cap value. And then I wrote an update about it in December of 2024. And I can guarantee you my opinion hasn't changed on it since December 2024. So my beef that I have with small cap value is that, well, it has performed quite poorly since 2006. And so I find it's a real head scratcher, because it had absolutely stunningly beautiful performance from 1926 is when people first started backtesting
Mhm.
this approach. And we have data that people can simulate until about the early 1990s. And this is when basically Pharma French published their academic research. And then the outperformance of small cap value held up a little bit longer. It actually did quite well during the dot-com bust, and then also recovering out of the dot-com bust. And then in 2006, it was basically, it's like somebody flipped a switch. And so it's because we've had 3 market cycles since 2006, right? We had the peak before the global financial crisis. We had the recession and bear market, the recovery until the pandemic, then the pandemic bust, the recovery out of the pandemic, the 2022 bear market, and now a recovery again. So 3 full market cycles, and through these market cycles, we've underperformed the small cap value quite substantially. And so I made this case, and I want to also be quite cautious there. I'm not saying that this underperformance is in any way statistically particularly significant, right? It's actually, it could also just be due to noise. But what is definitely statistically significant is that the outperformance of something like 2, 3, 3.5% per year, that is definitely done. So we can statistically significantly reject the hypothesis that we still have the same outperformance that we used to have, say, between 1926 and 2006. And so that was just the point I was making. So it hasn't really worked very well. And then when people plot these cumulative return charts, right, starting in 1926, because you had this fantastic outperformance until 2006, and then after that it stopped working, but it still looks like it's really fantastic outperformance if you start in 1926. And then I did some exercise. Well, what if we don't start in 1926, but we go the other way around, right? Imagine we start in, say, December 2024. How far back do I have to go to get outperformance again, right? Because now I have the underperformance at the end, and then how much outperformance do I have to attach in the front end to again beat the, say, the S&P 500? So and then I found some pretty mind-boggling stats where I said, well, unless you started investing in small cap value something like in the 1980s, you still didn't outperform the S&P 500, right? So because I know very few people who started investing in 1926 and stopped investing in 2006, right? Because the most people we know today are the people, this is the end point, and then you look at different starting points, and where are we today? And it gets even worse when we do exercises like not point-to-point investment, right, buy and hold, but we do investments like regular investments. Like you invest $1 every month, then you look at what comes out at the end. Now you have basically sequence of return risk, right? The outperformance in the beginning is much less useful because the underperformance towards the end that's when you had the big portfolio values. So you have to go, I think, even back to 1977 for a regular investor to come out ahead with small cap value. And so I'm just pointing this out, and I'm just saying, well, it's kind of disappointing. And because a lot of people reach out to me, well, I hear everywhere, well, yes, VTSAX is a great fund, but you could be even better, right? So it's good enough for the average retiree, but the really sophisticated experts, they would use small cap value. And again, but if you haven't started in the 1970s, it wouldn't have helped you. So that was my beef. And so, I mean, it goes back. Part of it is a statistical discussion, right? How statistically significant was the outperformance? Say from 1926 to 2006, it was really quite statistically significant. Now, the underperformance wasn't statistically significant because there's so much noise, right? I mean, you look at a small cap value fund, you have a tracking error that's potentially just like almost as big as the equity volatility itself, right? So so the difference in returns between small cap value and the S&P 500 is sometimes just as volatile as equities, or close to it, maybe 12, 15, 18%.
Sorry. I
Yeah.
take it you don't tilt your portfolio towards small
No,
cap value.
no. But I
Because
should
if
also
you
point
said
out,
yes to that question, then we were going to have to
well,
start all over.
because I also don't point it in the other direction either, right? It's not like I'm not happy with my total index fund, and I sell my VTI or I have a lot of Fidelity funds, so it's not like I'm selling my Fidelity equivalents of the VTSAX and then invest now only in large cap growth, right? Because I don't have a strong opinion either way. I think markets are efficient. And it's I want to hedge in each direction. So I'm not saying that small cap value has to underperform, but I'm also not convinced that it will outperform. So because of that, I'm still in my total market index fund.
Okay. For what it's worth, I've kind of come to the same conclusion. I tilted towards small cap value for a very long time. Ultimately, I stopped not because of mainly just to simplify my portfolio. I also got out of a separate REIT fund, and I think that's a perfectly reasonable. I think REITs are a perfectly reasonable option for a portion of the portfolio. But anyway, so another question that folks ask a lot, and I'll put one of them as an example, but it has to do with safety and security of our brokerage accounts and getting hacked. And I'm curious how you think about that and what you do to protect your accounts.
Right. So obviously all of my brokerage accounts are linked to my Gmail account. And so I actually think it's nice to, first of all, secure my Gmail account. So I have these security tokens. The person who pointed me to this is this guy, Harry Sitt. I don't know if you ever ran into him. So he has a blog.
He's great.
I met him at the Bogleheads. The first time I met him in person, but of course I knew him before that. So I like the idea of more cybersecurity is better than less, especially considering how cheap it is to be safe. I think it cost me something like $50 to buy 2 of these tokens on Amazon. And so that means that nobody can log into my Gmail account unless they have both my password and one of these tokens. And they might hack my password somehow, but they can't. Hopefully, I cross my fingers, they never have my password and my token at the same time. So that already covers some of that security.
Let me ask you, the token, is it a physical hardware key?
It's a physical token, yes.
Yeah, okay. Which one do you use?
And it has a little Y on it. I think I have to research that. It's one of the tokens that Harry Sitt recommended in his write up on that. But anyways, so I think that's already worthwhile to do the cybersecurity. And then I remember even maybe if just a few weeks ago, you mentioned that you have 2 brokerage accounts with 2 different companies. And, if one fails, then the other one is still available. So I have Fidelity and I have Interactive Brokers. And I like to have 2 accounts, right? Because what if something gets hacked or gets shut down or gets threatened by some basically blackmail terrorist that is shut down a site and I don't have access to that site. So I would like to have 2 brokerage accounts just for that reason. So so there's obviously the concern on my side and on their side. And then there's obviously that spiel about, even if a brokerage company goes out of business due to bankruptcy, right? So my assets are held in custody, and they would not be impacted by that. So that's something that you want to point out. It's basically cover 3 bases. Right? First of all is that investor protection, then spread your accounts over 2 sites, and then secure your email address that's tied to these investment accounts.
Yep. All good. That's basically what I do. This next question I'll take a stab at to begin with, and it has to do with rebalancing an inherited portfolio with 130 single stocks. So you said you inherited it 7 years ago. So I assume at that point you got step up in basis.
Yeah.
But of course it's been 7 years. And so stocks like Apple and Microsoft have just been on a tear. So, it's any of these tax questions, it's a very specific analysis, so there's no way we can talk generally about it, but it's going to require very specific analysis. Part of it for me, I can tell you how I would think about it. one of the first questions I would ask is, when, if ever, do I need this money? Forget rebalancing. Am I going to ever sell to spend it? Because if I'm not, and that might be, or I'm not, or maybe there's part of it you're not going to sell, and you're going to donate it, or leave it to someone when you die, I might just leave it alone, right? Because they'll get a step up in basis, or if it's a charity, they won't pay taxes. And then for me, first of all, I would look, 130 positions. Are there any at a loss, right? I can sell those too and offset the gains with the losses. But then for me, it would be a question about my overall portfolio beyond just these inherited stocks.
Right.
How important is this to my retirement plan? And depending on that, I could do everything from leave it alone to, in some planned fashion, sell it. My point, though, I think for me would not be to rebalance the 130. If I were going to sell, it would be to probably get out of stocks and put it in an ETF.
Right.
But those are very general observations. It's going to depend so much on the specific circumstances. Karsten, have you inherited a portfolio with 130?
No, unfortunately not. I never inherited anything major. But I mean, again, it's not very useful advice to this particular person because it's 7 years too late, right? If you wanted to rebalance this, you should have rebalanced it when you inherited it, to basically sell it and buy all ETFs and just be done with it. But for the other listeners who might find themselves in that situation, so probably you want to do the rebalancing at that time when you can, tax-free, because you have the tax step-up basis. Yeah, but I would go with Rob's advice. So if this is relatively small potatoes for your overall portfolio, just keep it now, because it's you might have some gains in it. Obviously, tax loss harvest the ones that have losses, but the gains, maybe now you have to plan for the next step up basis, right, for your heirs, and you can't get out of your Apple stocks anymore because they are now so appreciated, and you don't want to rebalance it now. So yeah, so not much. Yeah, I'll just go with Rob's advice there.
Good. All right. Well, that was easy. Okay. I think this has got my name on it, but I think maybe it's addressed to you. Please address the difference between Cape 1 and Cape 2 in the spreadsheet. So that's such an easy
question. That is very easy for me. Probably Rob hasn't.
I have no idea.
Hasn't graduated to Cape 1 and Cape 2. So I have this. I have this blog post on the CAPE ratio, right? So, and where do you get your CAPE ratio data, right? You could go to the Schiller website. Unfortunately, what Schiller publishes is usually many months outdated. And I don't know, I mean, he is obviously not doing this anymore. It's probably some research assistant, and maybe they do this only every 3 months. So I created a Python code where I download market data and earnings data every day, in fact. And I calculate the CAPE, and then I calculated 2 different ways. I calculated the way Schiller would have calculated it if I were Schiller's research assistant. And then I actually do it a little bit better than he does, because his earnings data is usually hopelessly outdated, right? So if we are in Q1, the last finalized earnings data he would use is still Q3. And I updated, because there's some earnings estimates, right? So fourth quarter earnings data, it's already coming out, and there's a pretty good estimate. So I already have fourth quarter and even first quarter earnings data. So I already update the earnings data a little bit with earnings forecasts. But so I calculate the CAPE as the same way that Schiller would have done it, plus that additional earnings data with a little bit less of a data lag. And then I calculate it. So this is the CAPE 1. So if you prefer Schiller's approach to the CAPE, you would use the CAPE 1. And then the CAPE 2 or CAPE.2 is the way I calculate. So I also do some adjustments to the CAPE ratio, and the adjustments have to do with different dividend yields and different corporate tax regimes over the last 150 years. So I do some adjustments. I could talk a whole hour just about that. So you can go to my site, and it's I think it's called Building a Better CAPE Ratio, and that's If you search for that, I go through my procedure there. But there's a nice thing is, so I run this Python code every day, and then I upload this to a Google Sheet in the cloud, and you can access it there. And then also my safe withdrawal rate sheet links to that. So you can see every day the most recent estimate for the CAPE ratio. And you know, sometimes I'm traveling or somewhere, and then I don't update it for 9 days, and I get requests via email. Hey, your CAPE is 9 days outdated. I say, yeah, come on. I mean, Schiller's is 9 months outdated. But yeah, so that's where that question came from. CAPE 1 is Schiller, CAPE 2 is Big ERN.
My goal in life is to truthfully start a sentence that begins with, so I created a Python script. That's my goal. I recall, and maybe it's the article you're referring to, maybe not, that you wrote an article, and it was something that I had been thinking of, but that you pointed out that the CAPE ratio, the way it's constructed, has some issues.
Right.
And you identified, I think, several, but one that stood out to me was the change in the corporate tax code.
Right.
Although now we're almost at 10 years, because wasn't that 2017? So, I mean, we're kind of getting close to having a full 10 years of earnings, you know, post that change, although it might have gone into, I don't know if it went into effect in 17 or 18, but and of course it could change after this year. We'll see what the government
17
does.
It was passed, 18 was the first year it was in effect.
Okay. So how, I mean, putting aside the how current the data is that we use for earnings,
right?
Do you think there are other issues with the CAPE ratio? I guess my recollection from your article was that you concluded it's probably lower than what Schiller has it at,
right,
but it's still pretty high.
Oh, it's still outrageously high. So I think the Schiller CAPE is something like 36, and my Schiller, my CAPE is something like 31.6. So it's still outrageously high.
Yeah.
And it looks a little too high to be too comfortable with your equity portfolio. So I share that view that you have broadcast the last few weeks.
It's really high. But do you ever think so it's high, but I mean, it doesn't sound like you're doing anything. You're not changing your investments because of that. I know you've got an option strategy, but do you ever think about, like, so I don't own gold. Mm-hmm. At least not directly. I suppose if you own the total market, you have some exposure to commodities, but I don't own Bitcoin or other crypto.
Right.
But sometimes I think, should I own something in case the system as we know it blows up? It's just that I can't figure out what that should be. It's like, I need to wait until the system blows up and I can see what happens, and then I'll know what I should own.
Right. So, yeah, I mean, the problem is, if you want to hedge against some market blow up, right, the insurance is so prohibitively expensive that it's basically it answers itself. There was in my most recent blog post where I talk about the option trading, I linked to a video. Bob Litterman, so he's a pretty famous guy from Black Litterman, the Black Litterman formula, right? So Bob Litterman made this presentation because when he was at Goldman Sachs, he was a very senior guy at Goldman Sachs. So they were talking about, well, how can we hedge our equity risk, right? So against some black swan event. And so it just turns out that it's so prohibitively expensive that so his recommended solution was, so instead of hedging against this risk, basically take down your equity exposure. And then to make up for the lost expected return, you actually sell some of that black swan insurance.
Oh.
So which is, in a nutshell, what I'm doing with my option trading, right? So you can take down your equity share a little bit, and so you actually sell some of that black swan event insurance and make a little bit more than just having a plain equity portfolio.
When you say sell black swan insurance, are you selling puts, or what are you
selling puts? I think that's actually the better way. So he was doing some simulations where he was so he was shorting the VIX, right, which is actually an extremely dangerous method because the VIX has no upper bound, right? The S&P 500, obviously, it can fall, right? But I don't think it's going to fall by 50% in one day.
You just jinxed us.
The VIX can definitely, I mean, there's nothing that keeps the VIX from going to 200
Yeah.
by tomorrow,
Yeah.
right? I mean, if we have a
Yeah.
big enough blow up in the market, definitely the VIX could go above 100. So it actually killed some VIX shorting ETF, multiple, I think, in 2018. And it wasn't even a particularly big blow up. I mean, the VIX went up from 15 to 30 in one day, and it knocked out an ETF called XIV. So XIV, so the inverse VIX, right? So
I think I read about
they're
that.
shorting the VIX, and it went down by 95% in one day, and then they shut down the ETF.
Yeah.
So there's nothing that keeps the VIX from going through the roof. I think there's some natural, basically circuit breakers that keep the S&P 500 from going down within one day, and so there might be some. Basically, market will be paused for a while, but the VIX definitely could go up. So I mean, long-winded answer. So I don't think that there is really any great alternative to just keeping your risky assets. Maybe change the exposure to the risky assets, keep some safe haven assets like treasuries, which right now don't have a terrible expected return. And then I also don't recommend that average retail investors try to do any kind of market timing scheme, right? And so you and I think we're on the same page there. We both agree that equities are a little bit lofty, bonds seem to be okay. So maybe do this glide path approach that I just mentioned, but I wouldn't do any kind of drastic changes in the asset allocation. Right?
Yeah.
So sometimes people is that they go completely out of the market, and then when do you have to go in again, right? So that's the other thing. So also looking back at history, right? When did you get out before the .com bust, right? I mean, there's some people that got out in 1997. And then maybe got in back in 2000 and thought, okay, well, I give up. And then they got basically whipsaw like that. So it's very hard for the average retail investor to be a good market timer like that. And by the way, even so when I worked in institutional money management, right, we had very sophisticated models for that. And we also knew that just a pure valuation model is terrible at just short-term return forecasts. You need something a little bit better than that. And then as a retail investor, you'll be totally lost if you try to do any kind of market timing.
Right. Yeah. Fortunately for me, I didn't have much money in the market in me
neither. I just got my first job around that time, and you put money in, and you see it dwindling away, and at some point, the portfolio drops faster than you put money in. So
I vividly remember that very thing, and I would joke about it with a friend, a lawyer, and where I worked, the firm I worked, where you'd put money in, and then your balance would fall below that by the next payday. You put more in, it'd fall below. But of course, at the time, I didn't fully appreciate how wonderful that was.
That's
right. I mean, it was an incredibly positive thing for our overall, wealth going forward. But anyway, all right. I'm going to break this question into two things. The question from Ethan has to do with when you think, you mentioned your 75-25%, but when it comes to retirement, folks often think in terms of their fixed income, not in terms of percentages, but in terms of years of expenses, and that's the bucket strategy. So that's sort of question one. But a second question that I'd be interested in your thoughts on is, how much cash do you keep on hand? Now, I've read your articles where you say your emergency fund is, and I think you're rounding here, but $0.00. And I don't know if that's still the case.
Right.
So if it is, I get, but I'm thinking even beyond an emergency fund, just I guess as an asset allocation, you have stocks and bonds. Do you keep T-bills? Do you have a separate allocation for what I would call cash?
Sure.
Let's start there. Do you keep an allocation to cash?
Yes, I do. And so this is another way in which I have evolved over time, right? If you are still accumulating, I think you can have 100% equities, right? And then if you already have 100% equities, if you have another, say, if you take 100% equities. They say, well, now I need an emergency fund, and it has to be in a money market account or in SGov or T-bills. And that takes down your equity portfolio from 100% zero to 98% stocks and 2% money market. Well, what difference does that really make in the big scheme? So when I was accumulating, I was very aggressive. I had a lot of equity exposure. Now I'm retired, right? And 75% fixed income. Yeah, that also has some shorter term, right? So I have some SGov. I have this new ETF. It's called BOX, BOXX, and it's this box spread ETF, which does a particular option trade that will functionally behave as if it's a zero coupon bond. But the nice thing is the way they package this into the ETF, and I don't know if this will last forever, but it will just accumulate within the ETF without ever creating any taxable event. And then I can sell that box ETF after 1 year and 1 day, and then only owe long-term capital gains, even though this is really, for all practical purposes, it's really it's really a short term. It's like a T-bill.
Yeah.
And you make it even a little bit more than the T-bill. So yes, I absolutely have that, and what has changed is that I'm in retirement now, right? So again, I want to have some fixed income. On the fixed income side, I don't blame people for saying that, well, I don't want to have 75% only longer duration, either very long duration or intermediate duration bonds. I also want to have a little bit shorter duration to, say, hedge against some central bank uncertainty or an inflation shock. And you have a little bit of cash lying around, and I've definitely, I'm one of those people. So.
But it sounds like so 25% is fixed income,
right?
How much of that is in short term, like under a year duration?
I think it's probably something like 3-4%.
Okay, so relatively small.
Right, it's relatively small, yeah.
And okay, does your fixed income include both nominal bonds or treasuries, whatever, and tips?
And I have nothing that is designated tips. I have a few preferred shares, and I understand that preferred share, you should not call this 100% fixed income. But what I like about some of the preferred shares is that they are adjustable rate preferred shares. So they were tied to the LIBOR. I mean, it used to be LIBOR, and now it's replaced by the SOFR, the short-term overnight funding rate. And there's a spread between the LIBOR and the SOFR, so that's also accounted for. So in that sense, it's almost like a TIPS, in the sense that if the Fed reacts to an inflation shock and raises interest rates, then there's a bump in your income. And then when the Fed lowers rates again in response to lower inflation rates, you will also have a little bit less interest income. But it's a nice thing about that is it's not universally true, but most of them, they pay this as a dividend, and it's a qualified dividend. So you have a little bit lower tax rate on that.
That's a great idea.
It's a great idea, but absolutely, it is not 100%. So the way I do this is basically what you can do is imagine you have $100,000 worth of a preferred share. I wouldn't call this $100,000 of fixed income, right? Yeah. This is probably something like 50% fixed income, 50% stocks, because these are usually issued by big banks like Goldman Sachs, Wells Fargo. And while the preferred shares are not quite as volatile as the underlying stocks, there's a totally 100%. There's some correlation between the two. And I had some really nasty stomach ache in March of 2023, right, when some of these California banks blew up. And it never impacted any of the banks that I were working with, because it's basically State Street and Goldman Sachs, Morgan Stanley, Bank of America, Wells Fargo. But everybody got hit around that time, just because, I mean, just by association, every bank and every preferred share got hammered around that time, whether it's big banks or small banks. So definitely, I'm not counting this. So when I'm saying 75% fixed income, so that is the fixed income portion, and then half of my preferred share portfolio, I count that in my stock portfolio. So
Well, that seems to make a lot of sense to me. I mean, they're obviously not as safe as a U.S.
right,
issued TIPS bond.
right.
It sounds like you're buying individual securities. You're not buying some sort of preferred ETF.
Right. And I used to do the preferred ETF a very long time ago, and then I noticed it's the iShares. I think it's still in the 40s, 40 basis points of fees, and now there's a similar one that's in, I think it's about 25, 24, 25 basis point fee. And I thought, I could do this just by myself and save myself a lot of that expense ratio. So that's when I started doing that myself. Then on top of that, I prefer to have these adjustable rate preferred shares, and so I think there are designated preferred shares, or the variable rate preferred shares. But even there, I mean, there's high expense ratio. I'd rather do it myself.
Yeah, and I get the idea of adjustable rate, so it can, if it can fluctuate with the prevailing rate, which is influenced by inflation. It certainly, though, doesn't have the same inflation protection that a TIPS does. So that's probably something for me, I probably wouldn't go down that path. I'd also be a little concerned about having too much exposure to the financial industry.
Right.
I mean, they're obviously big, well-known banks, but bad things happen. But as you pointed out, it's a split in terms of your allocation, and it's part of an larger portfolio. So, do you have exposure? And I'm going to pull up this question. Do you have international exposure in your portfolio?
I have a little bit in one of my 401ks, but I have to admit I've been so lazy, and in some way this complacency and statism and being too lazy to shift anything has helped me, because obviously international has underperformed for a long time. And I think my international exposure is only somewhere around 3 or 4%.
Okay.
And I got lucky with that, and never saw a huge rationale for going back into international. So I'm from Germany, and I'm a little bit pessimistic about kind of the German economy, and with Germany goes Europe. So so the way I rationalize it, I think the US it's more expensive, but I think it's also more expensive for a reason, or vice versa. Europe is cheaper, but it's also cheaper for a reason. So I think I'm pretty well served right now with the US centric portfolio.
Okay. Yeah, I much prefer more in international, although it's still relatively small for me.
Right.
But okay, this one's about your spreadsheet, and I don't fully understand it. But Karsten, on your spreadsheet, when I add Social Security and small pension, my SCR, I don't know what that is.
Safe consumption rate.
What's that again?
Safe consumption rate.
Okay. Appears to be around 8.5%. Can you explain what that means as far as a safe withdrawal rate?
So, I mean, for example, in the easiest possible case, so imagine you have $1 million portfolio, you have something, imagine it just generated a 4% safe withdrawal rate, right? To keep the same terminology. But then on top of that, you also have another $30,000 in an inflation adjusted pension, say some government pension. So how would you factor this in, right? So you could say that, well, you do your analysis completely separate, right? You do your safe withdrawal rate for your portfolio is 4%, and boom, you're done. So what would be your safe consumption rate? Well, it would be the $40,000 and the $30,000 for your pension, and so you would consume 7% of your initial portfolio, and that seems to be safe over time. So this is why I make a distinction between safe withdrawal rate and safe consumption rate, because once you start receiving supplemental cash flows, there is a difference between what you withdraw and what you consume, right? So once your flows and your supplemental cash flows start, there's a difference between safe consumption and safe withdrawal rate. Now, what happens for most people is that, well, the supplemental flows, they're going to be later in retirement, right? So imagine instead of receiving $30,000 today, the $30,000 additional income, they start coming in 5 years into your retirement. And I mean, you would be really way too pessimistic if you still consumed only $40,000 out of your portfolio today, because you should take into account that in the future you will have this additional cash flow, and then once you have this additional cash flow, you will start reducing your withdrawals one for one by that additional cash flow. So initially, you would probably withdraw a little bit more, maybe not increase it by the entire $30,000, right? Because you have to make up this 5-year gap. But maybe you could already take up your, and this is basically what the spreadsheet will tell you, right? They will calculate what would have been the safe consumption rate in historical simulation. Maybe you can take your initial spending up by $25,000, not the entire 30. You definitely don't want to do zero. But imagine you can, or let's take even a round number and be super conservative, and you take up your initial spending by $20,000. So it means initially you actually withdraw $60,000, but then over time, once your $30,000 of additional income kick in, you take down your withdrawals to $30,000. And so to basically, so I was debating long and hard, and I think the most consistent and logical way of labeling things was to basically do this distinction between what you withdraw and what you consume. So, and they may be the same for long stretches of time, but there will come a time when what you withdraw might be different from what you actually consume every month.
Right,
and
right.
So this is why with a lot of additional cash flows, you can have these very large initial withdrawal and or consumption rates as high as 8.5%. It's basically the sky is the limit, right? So you could have even higher. Imagine you have only $500,000 today, but you expect a $5 million inheritance next year. Well, you probably already take that into account as a future cash flow. And then you basically draw down your initial portfolio during that time until that cash flow comes in, and then you put that into your portfolio. So,
but I would tell the person I'm inheriting from that they got to die next year.
Yeah, well,
I mean, it's baked into my plan now. You can't let me down.
That's right, and I probably give it a haircut until they are actually in the ground. So it's yeah.
No, but that's a good point. I've actually spent some time with your spreadsheet. It's on my to-do list to really buckle down and spend like a day with it, and then do a video about it, because I think it's just an excellent resource. Folks can, I put a link to it in the chat like 20 minutes ago, but okay. So this is a good question. I kind of get versions of this a lot. A 70-year-old living off of expenses covered through Social Security and pension. They have an emergency fund. Is there any need to have bonds in a Roth retirement portfolio? I mean, I'll just give you my answer. If you're confident about what you just said, then no, right? I mean,
no,
it sounds like right. I mean, it comes down to when you think you're going to need to spend the money.
Right.
And as I read the question, the answer is they don't think they'll ever need to spend it.
Yeah, and then just keep it in there, and basically you will give it to your heirs, or maybe consider tapping that Roth IRA and spend more money already, right? There's a whole idea about this die with zero. Maybe you want to spend it while you're still alive. There's a saying in German, you want to give stuff with warm hands as opposed to cold hands as a dead person in the morgue. And so think about what good you could do with that Roth IRA. Is this already something you could give to somebody, or maybe you keep it, let it accumulate, and they will then inherit a Roth IRA, which, by the way, is not as useful as it used to be, because they will have to withdraw it over 10 years. But so
still ain't bad.
It still ain't bad.
Yeah, and as I think about it, even if someone said, "Look, I've got my expenses covered with Social Security and pension. I may spend the Roth money. I don't have to, though."
Right.
Even then, you could, if you wanted to, you could have a fairly aggressive portfolio, because at that point you're not sacrificing, you're not risking your house, and food, and you're risking, I guess, discretionary spending.
Yeah,
So
exactly. I mean, so one goes back to what do you do with the portfolio, and then what do you have in the portfolio? Yeah, I mean, obviously you could make this as aggressive as you want, right? Do 100% equities and let that grow, and never have to worry about any sequence of return risk, right? Because I mean, over time, over long horizons, you're guaranteed almost to beat the bond market or beat some portfolio with T-bills. Yeah.
did you see? I don't remember the name of it now, but there was a recent paper that came out. I've got it in my files somewhere that said, this idea that stocks always beat bonds in the long term actually isn't true. And but their reason for that was they had to go back to like the 18th century, 19th
Yeah.
century,
Yeah.
and
Yeah.
which I didn't
And
find particularly persuasive. I guess anything could happen, but
I found this amazingly unpersuasive. And I wrote 2 blog posts last year. It was somewhere in March. One was about this paper, right? Because there's this thing, stocks for the long run, right? So this person tried to attack this idea, stocks for the long run. And then there's the other paper who say that, well, you should have 50% international, 50% domestic stocks, and that beats any other retirement portfolio, which I also terrible paper. And I wrote a very long blog post to dismantle that paper. But the blog post before that was about that paper. About the stocks for the long run. Yeah, and of course, I mean, bonds for U.S. bonds at that time, when you go way back, right, they were basically emerging market bonds. And yeah, I mean, this is not too surprising. I think even today, emerging market bonds and emerging market stocks are not too different in terms of expected returns. But then at some point, U.S. Treasury bonds became something of a safe haven assets. I mean, certainly after the Second World War, and certainly after we got our monetary policy in order after Volcker. So now U.S. bonds are a safe haven asset, so which is good. They have some good properties in terms of diversification, but in terms of expected returns, they are not that good. And then the other thing that I found terrible about this paper, so not only going back and adding more data, which is just totally irrelevant for today's economy, right? Is not comparable to what we have to. There's this thing about, in statistics where they tell you more data is better because it becomes more statistically significant if we have more data. But then adding data that's irrelevant and is just a terrible comparison to today's situation that makes the situation worse. The other thing that I found really, really troublesome about that paper is, even though the paper came out, I think it was in late 2023, they never updated the bond returns when basically the bond market got hammered, right? So they pick this. So they looked at the different regimes of stock returns versus bond returns, and then in the final regime you have this very long bond bull market but no bond bear market. But then you compare it with an equity market that had both bull markets and bear markets, and you did not include the bond bear market at the end. I mean, you should have. That's another troubling issue, right? That the bond bull and bear market regimes are longer than the stock market bull and bear market regimes. That's the other troublesome thing, which I don't like so much about bonds. It can help you a lot, but if you're in bonds during the wrong time, I mean, that's really, really bad.
Well, yeah, it's like from 66 to 82, you'd love to be in bonds, and then from 82, not so much. Although the first decade of this century, bonds looked pretty good compared to. But it is interesting that bonds can outperform for a decade or more.
Right. Yeah. For sure.
I'll just mention before we go to the next question, that second paper, the 50-50.
Yeah.
50. They said it's 50% equities, 50% or 50% international, 50% domestic. That whole paper was based on the same data set they used for a paper like a year or two before, where they said the safe withdrawal rate is 2.7%.
Right.
And I read it then, and it's like their data set makes absolutely no sense in terms of, at least maybe in an academic setting, I don't know, but in practical applications, it's got zero.
Yep, absolutely.
Benefit. Kind of what I would want. I don't know if your spreadsheet does this. I don't know your data, but like, I think it would be interesting to take the equivalent of Vanguard's VT, just a global equity portfolio, but take that back like 150 years in terms of data. But see, I don't think that's available.
Right.
But to me, that would be interesting, because
Right.
you're not. But that's not what the paper did, of course. And what the paper did was just really bizarre.
It
I
was
thought.
bizarre. Yeah, I mean, it's so bizarre that I don't think we want to even waste the time here to describe it. But yeah, it's bizarre.
Yeah.
And so there's a guy, Cliff Asness, right? He's a guy from
Yeah.
AQR. He called it financial finger painting, what these guys did. And it's
He has a way
and then
with it.
so in my blog post, I pointed out a few other basically some mathematical and logical flaws in that paper too. So you could argue, well, these are academics, so they do things differently. But even that part they didn't do particularly well. And then they also made it completely irrelevant to the average retiree in the United States, right? I mean,
see, this is what troubles me, though. I almost think so. I think that some people, this is true in all fields, they're looking for some sort of shock value.
Right.
So, and I'm not.
I do too, by the way.
Well, I should quickly say this may not have been part of their motivation at all, but it kind of feels that way. 2.7% safe withdrawal rate, 100% equities, 50 international, 50 US. It's like, I don't know. Anyway, you're right, though. We don't need to spend any time on it any more than we already have. So, do you have high yield bonds?
I don't have high yield bonds, but in a sense, some of this preferred share stuff. I mean, that is in some way even riskier than high yield bonds, right? Because basically the preferred shares,
right?
They can discontinue paying dividends without calling it a default event, right? So if you're a bond issuer, you have to pay the bond. If you stop paying, that means you have to declare bankruptcy. So preferred shares can, technically speaking, of course, it would be such a reputational risk for, say, Goldman Sachs to not pay the preferred share dividend, but so it's on my mind. I've looked at it. I think the last time I checked, I don't think the spread between high yield and risk-free assets seemed to be particularly enticing. So I think I'm keeping my preferred shares. But yeah, I mean, it's definitely something. If something blows up again, I think is definitely. It's a good time to shop around and look at high yield bonds and stock up on that.
Yeah, I gave high yield a look. So I'll listen to Howard Marks from time to time. I don't know if you know who he is, but he's written some books, but he's basically made his career off of high yield, going back to, I want to say, the 70s.
Wow.
But and he wrote a paper not long ago saying he thought high yields junk bonds looked attractive relative to other options. And I toyed with, looking at that. But at the end of the day, I decided I'd play chess instead of doing more research on that topic. Okay. So how do you, this is the next question. How do you approach, what's your withdrawal strategy? You're retired.
Right.
What's your withdrawal strategy?
And yeah, so I have to admit that even though I'm the expert on safe withdrawal rates and everything, so I can actually get away with not really doing what I'm preaching. So I have this option trading strategy. I do this in my taxable account. That's about 40% of my financial net worth. And just from that option trading, I'm almost 100% of my expenses are covered through that. And I get a little bit more from dividends. I get the preferred share dividends. I have some equity index funds in that portfolio, so they pay dividends. So that's more than enough to pay all my bills. And I never even had to liquidate any actual assets. But I also understand that not everybody can do that and should do that. And so I maintain my safe withdrawal rate series for academic and intellectual entertainment on my side. But yeah, I have to admit that my personal withdrawals have been basically just the cash flow from my option trading and a little bit of dividend income. I kept my retirement accounts. They're still untapped, especially because of my age. I don't want to and don't have to. tap them. But even my taxable accounts, I never even liquidated any assets. So
before I get to the next question, which I think might be directed at me, have you ever gone back? I don't know how long you've been doing the options strategy, but have you ever gone back and compared your results with just putting it into low-cost index funds?
No, I mean the whole point is I have the low-cost index funds. Well, some of it is Fidelity, and then some of it is the preferred shares. The option trading is on top of that, right? So you keep your assets as collateral, and then you do the option trading on top. So I don't want to basically market a strategy. Oh, well, in order to do this, you have to sell your VTSAX and then replace it with the option trading. So the option trading is on top of what you already have. So I have it in a portfolio that is preferred shares, some of this box, some cash just sitting in a money market account, some Fidelity index funds. Some other people I know, they have VTSAX. Some other people I know, they have a lot of, say, QQQ and NVIDIA and Palantir. So you can do this on top of any portfolio that you already have.
Are you, well, that's true, of course.
Right.
But I don't know your strategy, but does it involve, for example, selling calls?
Selling puts and calls, and they are not the puts and calls on the underlying assets. So this is not a covered call, right? So covered call is you own, say, so people do this, for example, with the SPY, right? SPY is a very liquidly traded S&P 500 index fund. It's from the Spider, is from State Street. No, I do this on the index. And so the little bit scary thing is that you sell naked calls and naked puts. But I do this very short term, and I have some risk controls. And so, again, I have a Python program that tells me what strikes I should target. So it's independent of the underlying assets. So, but it is on the S&P 500 index.
So just two questions then. Is it theoretically impossible, given your strategy, to have underlying shares called away?
Yes. Yeah.
Okay.
So
then I think it's not theoretically impossible that this trade could lose you money. That's a possibility.
Absolutely. Yes.
All right. And at times, has it lost you money?
Just recently, somebody asked me what was my worst drawdown in 2024, and it was 26 basis points. So not 26%, but 26 basis points. I had one day where the portfolio dropped 26 basis, or to 0.26%, and then I had to claw that back. And it took me a few days to do that. But yeah, I mean, obviously, so every once in a while you lose some money, and this is why you sell insurance, right? And nobody would buy insurance if they didn't think that they get paid out, or nobody goes to the casino thinking that they will never win at the roulette table or the blackjack table. But obviously, longer term, it's better to be the casino than to play in the casino. So that's basically what I'm doing.
So the next question from Dave: how do you reconcile what William Bernstein wrote about retirement calculators relative to safe withdrawal? So this is an article I linked to in my in the newsletter that went out Sunday. I don't know if you read it, Karsten, but so I don't think the point he was making was that retirement calculators in and of themselves are bad, but rather they require you to make a bunch of assumptions that could end up being terribly inaccurate, whether it's assumptions about inflation, about asset returns, for that matter, about how long you're going to live. And of course, he's absolutely right. I mean, we can make our best assumptions, but we don't know how they're going to turn out. But I still find tremendous value in retirement calculators.
Yes. Yeah.
And one of the things that I do is, I try to arrange my affairs so that I can be fantastically wrong about a variety of assumptions, and I'll still be able to feed my family.
Yeah,
so that's one, right? But also I stress test it, and I look at the assumptions I'm making, and how sensitive is the outcome to that assumption. In some cases, it turns out not that sensitive at all. In other cases, it might be very sensitive, in which case I tend to focus more on those things. But so I think the other thing that Bill said, I don't know if you read the article, Karsten, but he talks about TIPS ladders as being a pretty conservative but safe approach. And I agree with that. I wouldn't rule out at some point building a TIPS ladder myself for at least some amount of money. But there's downsides to TIPS ladders, right? So there's no free lunch here. I don't know. Do you use retirement calculators?
Well, I mean, my blog is about my personal retirement calculator, so which is basically a little toolkit and you can use that toolkit to replicate some of the work that Bill Bengen. And in fact, you can do it a lot better because I have monthly return data, right? So you can much more appropriately, for example, model the 1929 blow up, which with annual data you wouldn't capture really well.
Did you know that he did a paper that he looked at quarterly data?
Oh yeah.
He didn't look at monthly, but he looked at quarterly, and he did find that there was a quarter in 29 that was the worst.
No, because if you retired in January 1st, 1929, it was way before the peak. Then January 1st, 1930, you were already down from the peak enough.
All of this is kind of funny to me because I've read your work on this particular point, and I used to think, well, I don't have to worry about what Karsten's saying. I'll just retire on January 1st.
Yeah, that's right. And you just hope that all the market peaks always fall in the middle of the year.
That is such a nerdy joke.
Which, by the way, the 2022 market peak, right? That was on January 3rd. So
there you go.
Scary, right? So no, but anyways, but back to Bill Burnside. So I really enjoy his work, and when I was at the Bogleheads conference in Minneapolis last year, I sat not next to him but across from him from dinner, and he's a great guy to talk to. It's like drinking out of the fire hose. So he's a good guy, and I agree that for traditional retirees, right, you look at today's TIPS yields. You can generate something like a 4.5% withdrawal rate with the TIPS ladder over 30 years, right? And so why worry about the 4% rule, especially now, with equity valuations really high? So you should tailor that more like towards, well, could we be right in front of another 1929 or 1972? So I can see the appeal of that. But the problem is that if you go anywhere beyond traditional retirement, right? You do anything like FIRE, well, what do you do over a 50-year retirement horizon? No? So now with the TIPS ladder, first of all, there's no 50-year TIPS ladder. But even if you had a 50-year TIPS ladder and you do something like a 2.25 real interest rate, now you're already down to something like a 3.3 safe withdrawal rate. If you could guarantee a 2.25 real return, 2.25% real return over 50 years, you're down to something like I think 3.3%. I calculated, and it also depends on, do you do this annual where you take everything out at the beginning of the year, or you do it a little bit slower every month at the beginning of the month. So results change a little bit, and this would be depleting your assets, right? And as you mentioned in one of your podcasts, right? Yeah. You're comparing apples and oranges, right? Because the absolute worst case scenario under Bengen and Trinity would be the 4% rule, but in every other case, you have way more money left over. And whereas with the TIPS ladder, you, with absolute precision, you draw down your portfolio. And if you want to do any kind of, you want to leave some money to your heirs with the TIPS ladder, well, that will again further reduce your safe withdrawal rate. So now you're probably down to 3% or below 3%. If you want to leave anything, or you want to have some kind of basically a reserve at the end just in case. So I could see that TIPS ladder works very well for traditional retirees. Think about it. I think in the early 2000s you had TIPS interest rates of something like 3.5, 3.6% for 30-year TIPS. And I mean, you didn't need the 4% rule there, right? So you could almost do a asset preservation exercise with something like 3.6, and I think that would have translated into a safe withdrawal rate with depletion of probably maybe 5% or more over 30 years. So but again, even with today's improved interest rates, I think we're still a little bit lean. So 30 years is still kind of the sweet spot for the tips ladder. If you go anywhere beyond that, boom, you're already below 4%, and you might as well then try your luck with something like a balanced portfolio, 60-40. So,
yeah. I can't put this question on the screen, but someone asked, I guess you've at some time said you could maybe boost your safe withdrawal rate with an allocation of up to 15% in gold.
Right. I saw that
too. Today. And also, what do you think about gold for those that are still accumulating?
Yeah, probably while accumulation it might not be the best asset for accumulating, because the average returns, very long-term returns, were probably not that good. And then while accumulating, you don't really have to smooth out the business cycle. But it's definitely true that gold has some diversification benefits, right? It hedges against obviously inflationary periods, right? Just because, well, gold is a commodity, commodities go up if we have an inflationary episode. But gold is one of the few commodities that also does really well in deflationary scenarios. So in past recessions, in every single bear market that I remember, at least major bear market, gold had some very nice diversifying properties, which you didn't really need so much during accumulation. In fact, during accumulation, you almost want the opposite. You want more volatility because you want to really get these very cheap tax lots when the equity market is down. But yeah, in retirement, and I think it's part 34 of my series where I looked at, well, what happens if you add gold to your portfolio? And it definitely makes a little bit of an improvement in your safe withdrawal rate analysis. Now, question is, will this continue going forward? Nobody can be sure, but it's definitely true in the past and even the last few recessions. So it worked during the pandemic, I believe. It worked in 2022. So I think gold is, if this is your thing, you should do it probably. Same thing again. Even though I wrote about it, I thought it was an intellectually and academically interesting topic, but I haven't really implemented it myself. So with the exception of, I don't know, a few gold coins that I got from my godfather and uncle when I was a toddler, I don't really have any major gold exposure in my portfolio. But I mean, there's now obviously there's some very easy way to put gold in your portfolio. You got ETFs. You can do it through futures, right? If you're really, really adventurous, you could even do something like, because people worry, right? How do I put gold in my portfolio? I have to sell something and then buy gold, right? Well, what do you sell right now? Do you sell equities? Well, you lose the expected return from equities. Do you sell bonds? Well, bonds are supposed to be the diversifying asset anyway. So why do I sell bonds and put it in gold? That's kind of, you take one diversifier, put it into a different diversifier. So if you don't want to sell stocks to buy gold, right, one way would be to do it on margin, right? So and you don't have to do a lot of percent, right? It has to be just a very small allocation. Could be 5%, could be 10%, 15% is probably stretching it a little bit, but yeah, so somewhere between 5 and 15 wouldn't be a bad idea. But yeah, you could do it on margin potentially. So it's a very intriguing thing. I haven't implemented it, but I don't blame you if you find this interesting.
I got to tell you, the thought of buying gold on margin.
Yeah, it's yeah. But I mean, the question is, so if you buy gold as an ETF, right, you have to sell something. So are you going to sell your equity index fund? Also raises the issue that, imagine it's in a taxable account, right? So you might realize gains or so whereas doing gold on margin with futures, right? So you get a preferential tax treatment, right? It's a Section 1256 contract. It's considered 60% long-term, 40% short-term gains if you do it as futures. But yeah, maybe to start with, try to do it in an IRA where you do the asset swap tax free, and then just do it through an ETF, just to be on the safe side.
Yeah. Okay, I'm looking for our next question here. Let me see. I've got two different computers that I'm dealing with. So one person wants to know, we've alluded to your options and preferreds, but like, what does just the old passive index fund part of your portfolio look like?
Yeah, so I have basically index funds, equity index funds in my 401ks and IRAs and Roth IRAs, and my wife has IRAs and Roth IRAs. So that's pretty much all just Fidelity index funds. And then I have two former work 401ks. The one 401k is still with BNY Mellon. So BNY Mellon is actually an asset manager. We have our own index funds, and as I used to be part of that family and no longer. But so BNY Mellon has its own index fund. So there was super cheap expense ratios on these index funds. So I was very happy with that. And then I had my, that's still with that 401k plan at BNY Mellon. It's run by Voya. It's a pretty well-known plan sponsor. So I have that. And then I have another 401k that's with the University of California system. That's also relatively low cost, and it's very conveniently, it's also managed by Fidelity. So I have it under my Fidelity page. So I have everything consolidated there. And so it's also just US total stock market index fund. So it's very boring stuff. I don't really do anything crazy there. So, but the crazy stuff is the option trading, obviously. So I do that at Interactive Brokers.
Have you ever, you listed a bunch of accounts. Have you ever thought about consolidating?
So, I mean, right now, I think eventually I'm going to take that University of California plan. So this is actually the University of California, but I taught a little bit at UC Berkeley on the side. So I have a 401k plan through them. And then I used to have a plan from the Federal Reserve. I rolled that into a rollover IRA at Fidelity. And then I rolled it from that Fidelity into the 401k plan, because I needed to do some Roth conversions with IRAs that had a little bit of a cost base, and I didn't want to water that down with that huge 401k from my Federal Reserve days. So that's now all. But yeah, so eventually I definitely would like to consolidate that and basically take the University of California, even though there's no reason to consolidate because it's super low expense ratio. If you're in the UC plan, it's actually quite attractive. And then again, the plan that I have with BNY Mellon is also low expense ratio. I'm afraid that if I bring it over in the 2 or 3 trading days that this money is basically in no man's land, that we have some huge rally and I miss out on that. And so I probably leave it there for now. But yeah, I mean, if I could find a way to do the transfer instantaneously, I probably would consolidate everything at Fidelity. Yeah.
It is funny to me that in 2025 we can't do a near instant transfer.
Right.
And I get a lot of emails from folks about that issue.
Yeah.
So we're almost at the end. We've got a few minutes left, and I like to talk about non-financial things. Some people ask me all kinds of crazy questions, so we'll see what comes in. But one question for you, what are you reading here lately? Are you reading anything? Any good books? It could be fiction even. Or do you not have time to read?
You know what? I used to have to read a lot for work, and I'm not really reading much in terms of physical books. But obviously, I read a lot of research from. So I subscribe to all the research output from Morningstar and J.P. Morgan, and so yeah, I read the newspaper every day, like Wall Street Journal. But yeah, I can't say that I have read any exciting books recently. So yeah.
Well, I'm taking a college. I went back to college. I'm going with someone. We're going to a community college and taking a history course together.
Oh, wow. Nice.
So I'm older than the professor. So like
Wow.
he's talking about, 1977 when Carter signs the treaty to give Panama Canal back. And I'm like, yeah, I remember that. What do you want to know?
Nice. It's amazing.
Although in fairness, when he talks about the 1890s, that I don't remember so well.
Nice.
But that's been a lot of fun. And I plan to keep doing that. After this course, I think I'm going to go for astronomy.
Wow. Nice.
Which I might need some math to back me up on that. I'm not sure.
That's necessary for that. Yep.
But in terms of books, I've been reading a ton of great stuff. I've been working through all the presidential biographies, although I took a period of time where I kind of stopped, but I'm on Tyler right now. The thing is, Tyler is not a particularly interesting president. At least I don't find. Of course, he's not even president yet. He's a senator where I am in the book.
Wow.
Although his some of the things he did during the Civil War were far more fascinating than his time as president. But anyway, okay. So another question that I'm seeing here, we'll get back. This is kind of back to the finances. Do you I don't know, fear or plan for an eventual cut to Social Security benefits?
So I think I might just be in that sweet spot where I might not have to fear this, because there seems to be this unwritten rule that politicians are not going to do some kind of a rug pull where they tell the incoming people that are about to retire, well, by the way, your benefits will be cut. So, and I did the math, and I'll be 55 in the year 2029. And so I don't see really benefit cuts during this administration, probably not during the next administration. But then, so once something has to get fixed, normally what they do is they will probably raise the contribution rate, right, from 6.2 plus 6 points, so 12.4%, and then do a small phase in or a long dated phase in of benefit adjustments but they don't do it to the existing beneficiaries, and probably not even to several years before the age 62. So I kind of, knock on wood, I probably don't get a big cut, but just out of extreme caution, I give my Social Security benefits something like the 20% haircut.
Oh, okay.
Even though I may not need it, but my wife probably, she would get a bit of a cut. Yeah, that's for sure.
There was an interesting article. I don't remember if I included it in the newsletter, but it was from a retirement research center at Boston College, I believe it is, where there was a sort of a proposal to fix Social Security. There have been a lot of them. But this had 10 proposals, and they kind of tried to balance it between increasing taxes on the one hand and, I guess, decreasing benefits on the other. And, of course, they can always raise the full retirement age, which they've done in the past.
Yeah.
It's still a very political, it's a hot button topic, even raising the full retirement age. And I guess I understand why. At this point, I just put in my full retirement Social Security. Now I'm a bit older than you are, but I've never relied on the Social Security.
Right.
In my mind, I've always thought, okay, will my plan work if I don't get it, if something happens?
Yeah, but I mean, ignoring it would be it would be shortchanging yourself if you ignore it. So I think both extremes don't make sense. So completely ignoring it would be terrible. But I mean, totally relying on it is probably you're playing with fire there.
Yeah.
So.
Well, I think it depends in the context, right? So, for example, when I'm using a retirement planner, I include my estimated Social Security benefits. But I also ask myself, would we get by without it? Mm-hmm. If I were making the decision when to retire, right, then I agree with you. I certainly wouldn't completely ignore it.
Right.
I might discount it like you've done it. I don't know by how much, but I'm certainly not going to ignore it, because ignoring it could cause me to work 2 or 3 or 4 more years. And if that's not what I want to do, or maybe even longer, by the way, if that's not what I want to do, then I definitely wouldn't ignore it. But that doesn't really, in our case, it really doesn't have that effect at all. Well, we're a minute away from the end of our show. What's next for you and your website? Do you have some articles you're working on that you're going to publish soon?
Yeah, so I promised people to do an update on that small cap value. So I got so many comments, and so some people hated on me, and they said, "Well, you got to do this and this and this." So there's some loose ends to it. I think I'm still. The results are still the same. Is maybe quantitatively, it's maybe not as bad as it is. So I wanted to do that. I just wanted to write something in general about how much should we be worried about high valuations, right? So I saw somebody put a chart out on Twitter, and it's a scatter plot of some valuation metric, and then the subsequent return over 10 years.
Yeah.
And they kind of cut and paste the data such perfectly that it's just a straight line. There's not even any kind of volatility around that straight line. And basically, boom, with today's valuation, for sure, we're going to have 0% real return over the next 10 years.
They've been publishing the same chart for 8 years.
And I think it's a JP Morgan chart that somebody copied and pasted. And I definitely have to do some decluttering of that nonsense chart. But yeah, I mean, it's obviously, so the point forecast may be a little bit lower, but there's some uncertainty around it, and we should acknowledge that. So I definitely want to write an article on that. And then so people always keep asking me about my safe withdrawal rate sheet. It's really nice to do as a sort of one-time exercise, and then you find your safe withdrawal rate. How do you use the sheet on an ongoing basis? Right? So you imagine you're a retiree and you've been using this sheet. How do I use this now? Maybe not every month, but every quarter to update your number. So it basically goes through maybe some case studies on that. So I probably wouldn't do that because that's a recurring question. And yeah, so I got stuff to write, and then I got conferences to go to. And so I'm busy in retirement, much busier than I thought. So tons of stuff to do.
Will you be at the Bogleheads conference later this year?
No, I was at the Bogleheads last year. So I was one of the speakers, and I think it's in San Antonio this year. So I will check if I want to go there. But yeah, so I'll be at Economy in Cincinnati in March. And then I'll be at a smaller private event in Florida in April. And and then I have my summer travel. FinCon this year is in Portland, Oregon, which is just around the corner from me, so I'll attend that.
Okay.
Yeah, so that's
I've been to every one. Going back
rest
to
of the year is totally booked. So
good. Well, we'll see each other then at FinCon.
Yeah. Oh, wonderful. All right. I'll buy you a beer.
I don't drink beer, but I'll take. I don't know.
Okay.
I'll take a black coffee. I know that just doesn't seem to work, does it?
We are in coffee country. Yeah.
No, I that'd be great. So for everyone listening, Lord willing and the creek doesn't rise, I will be back with a live show 2 weeks from today. So that's March 10th.
That's good. Yeah.
We're getting close to spring. I can't wait.
Yeah.
All right, Karsten, thank you so much. Appreciate your time and your wisdom. And for everyone else, I guess, remember, until next time, that's how I end every show, Karsten. The best thing money can buy is financial freedom. All right, guys.